lifting or raising the so-called debt ceiling won't be the first time that it's happened. This is something that has been part and parcel of the American political theatre now for many decades. The issue at stake is not whether or not the United States government can finance itself. The mythology is that the government needs to borrow money from other people to pay its bills, but nobody ever asks where does that money come from in the first place. That money that's already in circulation actually originates from either government expenditure or private commercial bank lending. So that's how money actually enters into circulation in the economic system, both domestically and eventually through foreign trade and capital movements into the global economic system. The fact that the United States Congress needs to increase this so-called debt ceiling is a reflection of the fact that it continues to create new liquidity into the economic system, and it needs to overcome the political constraints that it itself has imposed through acts of Congress in the past. So the entire way in which money comes into existence is actually a political and legal decision. Money doesn't fall from the sky. Money actually, in this sense, is not scarce. The issue, though, is that this next move to increase the debt ceiling is taking place in a wider context in which confidence in the US economy and in the US dollar system, broadly speaking, is diminishing. It's diminishing not because of the existence of federal government debt per se, though obviously the bond market will have its own views about that from its own perspective. But it's diminishing because of two principal factors. One is that the financialization of the American economy over the last 40 to 50 years has progressively undermined the real economic foundations of the dollar as a means of payment. So from a global point of view, accumulating dollars is only really of use if at some point in the future you can use those dollars to exchange for things that you will find useful and necessary. But if there are fewer and fewer things that the United States provides and produces that can't be procured from elsewhere in the world, then the fundamental reason for holding dollars begins to diminish. The second reason why there is a crisis of confidence in the dollar system goes to the progressive weaponization of the dollar and its associated institutions over the course of the last 20 years. If you are to hold a currency on the basis that at some point in time in the future you can use it for certain things, then you need to have confidence that that currency won't be subject to the whims and the capricious desires, the policy chopping and changing of the monetary authorities that originate that currency in the first place. The weaponization of the United States dollar and the institutions that enable its flow around the world, such as the imposition of sanctions, the confiscation or the freezing of US dollar denominated assets, raises serious doubts in the minds of central banks around the world as to whether or not holding onto the dollar instead of something else is actually in the long run beneficial. So this question of debt will ultimately feed through into a couple of significant circuits, if you will, that further undermine the stability of the financial system. As I said earlier, the issue isn't whether or not the United States government can finance itself. It owes what it creates, so it can never run out of dollars. The issue, though, is as it does this and as these mechanisms come into play, whereby dollars that are created are offset by issuance of bonds, we end up seeing the need for interest rates to rise. And as interest rates rise, it creates a distributional logic or reinforces a distributional logic within the American political economy that ultimately undermines the stability of the social settlement and the American economy at large. So when the government pays interest on bonds, outstanding bonds, That additional money, that new money, is actually being credited to the accounts of bondholders, of course. Now, bondholders are basically wealthy institutions and to some extent foreign governments as well. So the payments that are being made will actually lead to the exacerbation of economic inequalities. On top of that, what that ends up driving is the consolidation of the financialization and hollowing out of the real economy. So it has a very powerful internal logic of its own, which increasingly hollows out the material foundations of American economic wealth. And so we end up with an economic system which is heavily tilted in favor of finance capital at the expense of the real economy of material transformation. And when that happens, we ultimately have a situation where holders of US dollars become increasingly aware that the real economy, the American real economy, actually has no capacity to remunerate on those dollars if you wanted to cash those dollars in. And that's why there is a growing crisis of confidence in the US dollar. Currency multipolarity has been unfolding now for quite some time, but it is not something that happens overnight. So as concerns about the US dollar grows, we have seen over the course of the last decade or so a progressive and moderate growth in the use of national currencies for the settlement of cross-border payments. But part of the problem and the risks involved in this process of transition is that there are still many countries that have outstanding debts denominated in US dollars, which means that untangling their debt obligations from a US dollar-centric system, whilst the US dollar essentially becomes overvalued relative to their national currencies due to interest rate increases, will actually put even greater pressure on the global south in the short term, because they could confront balance of payments crises where they are unable to settle their obligations in US dollars. Now, this will lead to a need for these countries to reshape their external financial exposure. And that's where the RMB does come into the story. China, of course, holds very, very significant US dollar reserves. And over the course of the last 10 years or so, those dollar reserves and dollar denominated assets have actually played an important role in the internationalization of the RMB. They have been used as collateral, in effect, for the issuance of RMB denominated credit that has enabled particularly countries of the Belt and Road Initiative to develop infrastructure and to participate in intensified circuits of global trade and exchange. So the likely dynamic that will unfold is there will be a greater need for the Chinese financial authorities to make their own infrastructure, if you will, and financial reserves available to assist the global south in managing their exposure to US dollar denominated debts. So this transition away from the US dollar or a US dollar centric environment to one where more national currencies play a role in firstly cross-border trade and in the medium term in financing economic activity more broadly speaking, is going to be quite a bumpy one. The aim, of course, is to minimize the extent to which these disruptions feed into not only financial and economic problems in global South economies, but ultimately, because of financial and economic disruptions, leading to social instability. And social instability can be obviously very negative for societies and also ultimately undermine the necessary conditions for ongoing economic development. So social stability and economic stability, of course, go hand in hand. The transition to the use of alternative currencies for cross-border settlements is developing at quite a fast pace, and in fact can happen quicker than many people would, in theory, think can happen if there is a need for it to happen. So a great example of that is Russia, which in the last 3 years has been forced to move away from a US dollar centric settlement system to one in which over 90% of its trade is now settled in non-US dollar currencies. Similarly, Chinese trade now sees a little bit over 50% settled in RMB, and about 73% of Russia's trade with ASEAN countries is now settled in national currencies. So there is no doubt that trading countries are increasingly looking to reduce their exposure to the US dollar as part and parcel of their own trade, and over time to reduce their risk exposure to fluctuations in dollar value, as well as potential risks of capital outflows by being exposed to the USD. These transitions will take some time, but there is no doubt that they are happening. There isn't a national central bank in the world that wants to be exposed in the way that banks have historically been exposed through not only the Asian financial crisis, when countries like Indonesia were really very exposed to capital flight, but also from the global financial crisis in 2008, when the contagion effect of banking crisis in North America ultimately led to liquidity problems in many other markets. So there will be a period of transition, and it will be at times potentially quite bumpy. We can only hope that the potential bumps in the process can be effectively managed so that the disruptions are as moderate as possible. But it is an inevitable development.